Welcome to my prep for the RBA meeting tonight, early this morning, whichever way you want to go through it. Obviously, my background when I was at JP Morgan, I traded the Aussie and Kiwi markets for 8 years, so this was very much my focus when I was there. At Futex, it hasn't been so much my focus, but that's partly because since I've been here, it's been pretty quiet and nothing much going on, but it's something I definitely look at, and you should all definitely look at. Interest rate policy globally around the world is going to be very important this year. So we should pay attention to as many central banks as possible. So I'm going to start off by just giving a bit of background on the RBA, then a little bit about Australian rates now and where they've been for the last 5-10 years or so. Talk about a little bit about inflation in Australia, a bit about the market pricing, then talk about the rate decision which is coming up. There's been a lot of conjecture about whether they'll cut rates or not. And it's the first time this conjecture's been there for a good 12 months to a year and a half. And then at the end I'll go through some of the markets that we can potentially trade. Okay. So the RBA, let's close this down. Okay, so the RBA, they are an inflation targeting central bank. The Fed, for example, target inflation and unemployment. The RBA is purely inflation. They are looking to keep inflation within a 2 to 3% band, and they're generally quite consistent at doing this, and this is a very clear focus of theirs. They meet 11 times in the year, generally in the second Tuesday of every month, aside from January when there's no meeting. The rate decision takes place at 2:30 p.m. Sydney time, which is 3:30 a.m. London time. And we get a release of the interest rate decision and a statement and nothing else. So it's a bit like what we had with the Federal Reserve. You get their interest rate decision and the statement. The statement is essentially dumped as opposed to read out like with, say, Draghi on ECB. So it's much more like the Fed and how they do things. The statement can be accessed straight away from the RBA website at 2:30 p.m. Sydney time. But for the purposes of when things actually come out on Bloomberg or Reuters, it will just be headlines, much like with the Fed. There's no press conference, there's no Q&A, there's no economic projections or anything like that. When they do come out, they occur quarterly, the projections, much like the Fed again, but it's in a different sort of format. It's not following an interest rate meeting. So the next set of projections, and it's called the Statement on Monetary Policy. It will happen this Friday, which is a few days after the meeting, and every 3 months thereafter. So that's when you get the RBA's inflation forecast, their growth forecast, a bit more explanation about what they're doing and what they have done. Okay, so interest rates now, as we can see from the chart, actually I'll just scroll on the mouse, it might be easier. We're down here at 2.5%, which is historical lows. The Australian interest rates have never been here before, ever. So like we said, all-time lows. But just going back to 2000, we can see that we've actually been as high as 7.25%, and this was kind of early 2008. This was at the time I was very much trading it. Then we got a huge cut in rates during the financial crisis. That keeps popping up, hold on. I'll just go up on the board. We've got huge cutting rates following the financial crisis from 7.25% down to 3%. And then actually post-financial crisis, we did actually start hiking rates in Australia, which is very different to, say, again, the US, the UK, Europe hiked rate once at the end of Trichet's reign. But we actually went on a hiking cycle, so it went back up to 5% and then started cutting rates again. So in the last, it's been different to most markets in that post-global financial crisis, most markets have stayed low and remained low. Australia has hiked rates, cut rates, been on a period of stability, and now there's a bit of talk about cutting interest rates. So this is why this has been really a great market to trade for a long time in the developed world, when the US was doing nothing, when Europe was doing nothing, when Japan was doing nothing, when the UK was doing nothing. Australia were both raising rates, cutting rates, and it was a very interesting time. And just what I would like to say as well, just before all these rate cuts, Australia were actually hiking rates. So if the financial crisis didn't come along, this 7.25% could well have been 8.5%. And we only got emergency rate cuts. I mean, we got a 100 basis point cut at once, which was probably the worst day of my career when that happened. But generally, the RBA do move in 25-point increments, as we can see from this nice stepped function. And we've been at this 2.5% yield level since August 2018 for the last 18 months. Okay, so as I said, in Australia, their mandate is to keep inflation within a 2 to 3% target band. The inflation figures came out last week, and CPI had dropped to an annual rate of 1.7%, which is obviously below the 2% that's in their target band, and it's the first time that's happened since mid-2012. Obviously, as with most inflation readings around the world now, oil prices, petrol prices has fed into that, and that's the fall in the inflation is largely because of that. So the RBA doesn't normally focus on, I guess, what we call headline inflation, which came in at 1.7%. They generally focus on what we call core inflation, or what they call underlying inflation, which strips out the volatile components such as petrol. And this was actually stronger than expected when the data came out last week, and that reading is at 2.25%, and that is within their band. So before I go on, has anyone got any questions about anything I've mentioned so far? Sorry, I should have touched upon that earlier. Anything about the interest rates, anything about the meeting? If there is anything, just stop me. Okay. So when I look at any central bank meeting, I will generally start with market pricing. And like I said, there's been a bit of conjecture over whether the RBA will cut rates at the meeting tomorrow. Now, if we look at market pricing, I've got the implied yields per meeting out to the end of the year. I've actually got that from the OIS markets, but you can imply that from the 30-day futures as well. But I've actually just got the OIS markets. They show exactly the same thing. So the current interest rate in Australia is 2.5%. For this meeting, the market is pricing 2.33. So they are, given that they move in 25 basis point increments, if they cut rates, it will go to 2.25. So essentially, there's 17 basis points of rate cut priced in, which equates to a 67% chance of a rate cut. If we go a bit further, March 2.19, so that's more than one rate cut priced in within the next two meetings. So essentially, the market believes there will be a rate cut. More likely than not, it will happen at this meeting, but if it doesn't, it will happen at the March meeting. And then essentially, if we go middle of the year, 2.022%, there's essentially two full rate cuts priced by mid-year. Is that clear? Anyone got any questions on that? Okay. So I guess if they do nothing, yes, it will be a surprise to the market because they're pricing it. But if they do nothing and indicate further rate cuts to come, maybe it's not such a surprise, because essentially there's just over one rate cut priced over the next two meetings. Now, if they do nothing and then maintain what they've been talking about before, there's always rates are on a period of stability, which I'll go into a bit later, then the market would find that hugely surprising, and this would probably all be repriced up to higher yields. And if we look at what the economists are thinking, only 7 out of 27 economists surveyed on Bloomberg actually think there will be a rate cut in February. Now, we've seen this with the Fed. There's often a misalignment about what economists think and what the market thinks, and even what the Fed thinks. But this meeting, guys, it's tomorrow, and only 7 of 27 are actually calling for a rate cut. Whereas it's probably, from the market's perspective, it's probably only 7 out of 27 that's not calling for the rate cut. So there's a bit of a disagreement amongst the trading community and the analyst community as of what's going to happen. The market is pricing it, the economists aren't calling for it. Even if we go into March, only 11 out of 27 are calling for a rate cut by March. Now the market is saying by March, 100% done deal. Economists aren't even saying a 50% chance of that. So this is where you have to realize in stuff that you read that economists, just because an economist says something, an analyst says something, doesn't mean that the market says that same thing. And I learned that very early on in my time at JP Morgan, and I used to find it quite difficult to comprehend why you get such divergences. But it's just something you have to accept and not be misled by. Okay. So it was really only last week that the rate cut bandwagon really got traction, and it came about from essentially an article in Australia's biggest selling daily newspaper, where a journalist called Terry McCrann wrote that the growth and inflation forecast would be downgraded when the RBA released their statement on monetary policy, which is on Friday. Remember what I said, projections are on Friday. And actually the opening paragraph of his column actually said, the RBA will almost certainly cut its rate at its first meeting back for next Tuesday. Now that's a huge call. That's a very brave call. At the time when this came out, the market was only pricing maybe a 7% chance for a rate cut. And this one guy has essentially, similarly like to how, you know, when we hear comments, ECB sources, but ECB sources can move the market, but this one guy in an article he's written in a national newspaper has really got a lot of traction. And why has he got a lot of traction? Because there was a time in 2012, 2013 where rumors that he had stuff leaked to him on numerous occasions because he called quite a few meetings correctly out of left field, and then he got a bit of a reputation for being the go-to guy at the RBA if they want to, you know, guide the market. You may laugh, but it's it's actually quite strange, you know, how this happens. It doesn't seem to happen anymore, but it did for a while. And I think once out of nowhere he called for a rate cut, and the market just was not even thinking about rate cuts, and then they delivered on the rate cut, and then he got a bit of a reputation for being able to call things right. But as I've said on the slide, after some complaints, the RBA introduced a media blackout in the week before board meetings. So we don't know if this is still the case anymore. I know towards the end of my time at JP Morgan, he actually called a couple of things quite terribly wrong. He actually wrote, I think a few years ago, 2 years ago maybe, about a rate cut. And the article he wrote was as if though they'd already cut rates, and then when the rate decision came, they didn't do anything. So it's just something to be aware of. You know, he may be right, he may be wrong. But he is essentially saying that the RBA will cut by between 50 and 100 basis points this year. It's almost a dead cert for February. And if not February, they will cut rates in March. That's what he's essentially said in his article. And this is what the market actually did, just to give you an indication, before and after the inflation data. So the inflation data, their core reading was actually a beat, and we went from the market pricing 42% chance of a rate cut to 7%. And then this was for maybe 6 hours or so. Then he released the article saying the RBA will almost certainly cut rates, and then it went all the way back to 40% chance, and since then it's actually gone closer to a 70% chance. So his article has got real traction. The Aussie dollar did a similar thing. It went from 78 cents up to 80 cents, then back down to 78 cents, and now it's at around 77.5 cents. Again, all on the words of one media commentator. And this is why it's getting a lot of traction now, because the market had, after the inflation reading, core inflation stronger than expected, within their band, 2.25% core reading, within the 2 to 3% band. That is why the market just priced out the rate cuts, but they got priced in almost 6 hours later. And I've traded, when the articles get released, they're generally out midnight London time, and I've traded traded the London sessions when these sort of articles come out, and you get some of the best moves on them because most of the Australians are asleep. The first time you just think, oh, it's a load of rubbish. Second time you think, oh, you're a bit skeptical. But then over time, he releases these. He's a regular journalist, so these articles come out, and then you know whether you agree with it or not, you just react and trade it. Much like you would an ECB sources, whether you think it will happen or not, it moves the market. Any questions? Okay. So, will they cut rates or won't they cut rates? So there's a lot of reasons you can argue for a rate cut and a lot of reasons against. So on the rate cut camp, obviously disinflation. The headline CPI came in at 1.7%, which is below the target band. Now obviously I said that's not, the RBA preferred to focus on the core reading, and that's an argument against the rate cut because the core reading is 2.25% and it's still within the band. But if we stick on the topic of why they could cut rates, low oil prices one. Again, that lower oil prices filled into lower inflation and the disinflation story again. Sluggish economic growth could be another reason. It's 2.7% year on year at the moment. It was expected to be closer to 3% the last time the data was released in December. I mean, this is not poor growth by any stretch of the imagination, but it's a bit slower than expected. Slowing Chinese growth is another reason. Like, China is a huge trading partner of Australia. Some people, because they can't trade China, they'll trade Australia, whether it's in the currency space, whether it's the bond space. If the Chinese economy takes a turn for the worse, it's almost guaranteed the Australian economy will as well. They're the biggest investors in Australia. They're the biggest importers of all Australian commodities. It's just huge. They are their biggest trading partner, and they are essentially, Australia are essentially very dependent on China. So slowing Chinese growth could be another reason why this rate cut might come about. Commodities, that's another reason. We've seen oil drop, we've seen gold drop, we've seen other commodities drop, but iron ore is huge for Australia. It's their biggest export, and it's at its lowest level in 5 years. In the last year alone, it's dropped from $125 to $64 in the last year. So for exporters, they're not getting anywhere near as much cash for their iron ore. So this is kind of, they've got to scale back on their investment because their income's not as big and what have you. Now, you know, with oil prices, we can see it could be a good thing longer term, but because Australia export iron, it's not going to be a good thing for them that their iron ore prices are so low because they're dependent on it. That's what they sell. They don't sell oil, so they benefit actually from oil prices being low because they don't produce it. But because they produce the iron ore, this is important to them. And it's not just iron ore, coal as well. It's another one that's dropped quite significantly. That's probably their second biggest mining export. So also another reason for the rate cut, we've seen other central banks cut rates. Bank of Canada cut rates, Reserve Bank of India cut rates, Singapore cut rates, the ECB embarked on QE, Bank of Japan extended their QE, the RBNZ played down, they took away their rate hiking bias. So we've seen other central banks, Denmark, as well, cut rates. We've seen other central banks easing monetary policy. Now, just because they've eased monetary policy doesn't necessarily mean Australia needs to ease monetary policy, but this all has an impact on the currency, which is a huge concern for Australia, because Australia's 2.5% benchmark interest rate is higher than, well, obviously ECB's is 0 to negative, the Fed's is close to 0, Bank of England's is approaching 0, it's 0.5%. So if they just keep their interest rate high relative to everyone else, you'll get this situation where everyone will jump into Australian bonds because of the higher yield. It will force up the currency, and the high currency is going to be a problem because ultimately they need as low currency as possible to offset the fall in the export costs, export income that they get from the iron ore and what have you. So if they just stand in isolation doing nothing while everyone is cutting rates or easing policy, their currency is just going to look even more attractive. Does that make sense? So that's why if you look actually during, and I'll bring this up a bit later, but during the financial crisis, when we said Australia would have been hiking rates, when everyone was cutting rates and when there were problems around, everyone went into Australian bonds. They were AAA rated. You still got 4-5% 10-year bond yields when everywhere else was sub 3% and sub 2%. And that's why you got this flurry of money into the Australian market. The bond market was really propped up. Everyone bought Australian bonds for the yield. To buy the bonds, you've got to buy the currency, and that's why the Aussie dollar went essentially from 70 cents to $1.10 in that financial crisis time. Historically, the Aussie dollar has been a currency where a risk aversion play. So when a risk off play would be sell Aussie dollar, but it actually got to the stage where it was very much a risk on play because they were still AAA rated. They weren't in trouble when other countries were, so everyone bought their bonds and propped up that Aussie dollar. Now, the Aussie dollar has come off, but probably not enough to offset the 50% drop in the iron ore prices. And finally, another reason for the rate cut, as we said, the RBA commentator Terry McCrann, well, they're not going to cut rates because of him, but with no RBA speakers, it could just be that they have leaked something to him so he can recalibrate the market's expectations. RBA are generally a fairly transparent central bank, and because they had no meeting in January, because they have 11 meetings a year, excluding January being the one that they miss, maybe they gave a commentator the heads up just to kind of recalibrate expectations. I know, Jack, you're smiling about it, but it's actually more than plausible. Doesn't seem very fair, I know. Okay, and against the rate cut, again, we mentioned inflation. The core inflation is not doing too badly. RBA have also, in every statement that they release with their rate decision, have talked about a period of stability, which basically has meant no rate hikes or rate cuts imminent. Just like Yellen has been using the word patient to mean kind of 2 or more meetings, just like they were using considerable time before that, the Fed, to indicate 6 months after QE that the Fed would hike rates. RBA's period of stability statement basically meant no rate hikes or cuts imminent. And this will raise, if they do anything, it will raise credibility issues, because RBA, if they do cut rates in February, it seems likely the market won't really accept what they say anymore, because they've been talking about this period of stability and then they're veering away from that. But I guess one thing that the RBA can fall back on is the fact that they didn't have a meeting in January to kind of realign the market to what they were thinking. The Australian dollar, while we talk about it being weak and coming off quite significantly in the last few months, it's actually continued to fall since the last meeting in December. 6% against the dollar, 4% in trade-weighted terms, and it's also nearing the 75% kind of target that Glenn Stevens, the governor of the RBA, talked about being as more fair value. He said that in December he thinks more fair value for the Aussie dollar is around 75 cents, and it's come off since then. It's now around closer to 78 cents. Another reason against the rate cut, the housing market. It's still, Sydney and Melbourne property prices are still booming. They went up 7-8% last year. Recent data last night just showed that they were still going on another 2% raise in January. So cutting rates, what will that do? That will only stoke that fire further. Low interest rates, stronger housing demand. And finally, lower petrol prices could be another reason against the rate cut, because as we said with oil, we've talked about oil many times, low oil prices, yes, they're disinflationary in the short term, but they're good for growth in the long term. So I guess to sum up, in terms of whether the rate cut could or couldn't happen, there are reasons that you could argue for both. Now, that Terry McCrann article that came out said it's almost a dead cert. And I guess that's why the market has got so excited by this. Any questions, anyone? Okay, so in terms of the markets, I'll talk a bit about the fixed income markets, a bit about the FX market, a bit about the Aussie equity market, and a bit about US bonds. Now, what you say, why US bonds? Because sometimes you can actually trade other markets on the back of this, and that's why I'll just mention a little bit about US bonds. So Aussie fixed income. This chart here is a chart of the 30-day futures in stir space. It's the February 15 contract, and they work a bit like the Fed funds. So essentially, we're trading now at 97.65. And how you imply the yields, 100 minus 97.65 gives 235 yield, 2.35%. So if they cut rates 25 basis points to 225, that should move 10 basis points. Right, so that should go to 97.75. Now, a trade I often like to do, and I've talked to you about this pre-Fed, is these risk-reward plays where you sell or buy futures contracts depending on perceived risk rewards. So if the RBA cut rates, we know that's going to go to 97.75. If they do nothing, it will remain at 95.50. So if they do nothing and I'm short, I can make essentially 15 basis points to lose 10 if I'm wrong. Now, the risk reward isn't compelling for me to do that at the moment, unless I have a really strong view that they're not going to do anything, that they're going to keep rates on hold. But if we got towards 97.70, 97.71, that's much better risk reward, right? It's a 4 basis point loss for a 21 basis point gain. So I would maybe look to short the market should we get up to those sort of levels, because I don't particularly have a view on the RBA, but for me it's good risk reward. If I think it's if I think it's a coin flip, whether they cut rates or not, if I have a trade where I can lose 5 to make 20, I will take that trade on, provided I think it's a coin flip, or provided I think that they won't cut rates. If I think that they will cut rates, if I think it's an 80% chance that they'll cut rates, then it's no point me doing that trade, because it's an 80% chance that they cut rates, but if they do cut rates, I make 80% of what I can lose. Yeah.
How do you calculate the percentage, like the possibility to cut the rates?
So they
based on the market? Or?
Yeah, for this you can do it just based on the market. It's very, very easy, because this is a very pure product. It's not like the 3-month futures. This is a 1-month futures contract, and it will settle at the RBA rate. So just say there was no meeting this month, and you know the base rate is in Australia is 2.5%. What will happen is those futures will essentially fix at the end of the month at 97.50. So down here. Yeah. So if the price of the futures contract is 65 now, 97.65, it's kind of telling you that there's 15 points of rate cut priced in. Actually, it's telling you a bit more. There's a bit more than that. Why is it telling you that? Because the meeting is not on the first day of the month. It's on the 3rd day of the month. So there's essentially 3 days guaranteed where the rate will be 2.5%, and then maybe some days after that will be 2.25%. That's how you price it. We can go into that another time, but it's very pure. You can't tell that from looking at the 3-month futures. You can't tell that from looking at, like you wouldn't be able to tell that in the US fixed income space from looking at the Eurodollar futures. You need to look at this or the Fed funds for the US. So you have to look at the 30-day futures. So that's how you work it out. But the percentage chance is essentially me saying 17 points priced in, 17 divided by 25 basis points times 100, you get the percentage chance. Assuming they move in 25-point increments. They don't always move in 25s, but when the markets are stable and the world is going on okay, they do. It's only generally in emergency cases where they'll move in 50, 100. But this isn't a panic move now. If they do anything, it will be an orderly rate event. Is that okay?
Okay.
Anyone else? Okay. So those risk reward trades, it's not quite there for me to do at the moment, but I would sell if we went above 97.70. By the same token, I'd buy if we maybe went down towards 97.55, because the risk reward for me buying is just as good as the sell. But where we are now, it doesn't really make sense, but it's something to keep an eye on. Oh yeah, and I just want to say actually, this is, for much of the year, or much of the last 6 months, the market hasn't been pricing anything. It was all really only this spike here where this article got traction. We sort of started to price in a little bit of a chance of a rate cut towards the end of last year, just as everyone else started pricing for other markets and other countries. But it was really this day here when the article came out that it really went. Okay, the Aussie dollar. Now I've said we've come off a long way, and I've said that the Aussie dollar really rallied during the financial crisis, and you can see that here from 2009 onwards it went up very, very quickly. Why did it do that? Because we talked about the bonds being attractive, money piling into Australia, it became a reserve currency, and so on and so forth. Since then it's come off as Australia cut rates, as rates globally converge towards each other. And in the last 6 months we've gone from 95 cents to a 5.5 year low at around 77 cents. Now, is there a trade opportunity there if they cut rates, if they hike rates? Anyone got any view? Yeah, Jack.
Should I get the short squeeze up? Get a short squeeze up because, well, like Biden's on the fact that they cut rates, so pricing as much as come off.
Exactly. That would be 100%. That would be my trade. I don't necessarily, if they do cut rates, we probably could extend further, but I'm not really sure how I'd trade that. But if they don't cut rates, as Jack said, the market looks like it's short. It's come off a long way. Even in the last few sessions, it's come off 3%, 4%. So the market seems to be positioned short. If they don't deliver on this rate hike, then yeah, I think there could be the potential definitely for a short squeeze, and you could just get some of this move reversed. But also, it will depend also on the statement, because they might just do nothing and then signal that they might prepare the market for a rate cut to come. But yeah, knee jerk, if they do nothing, definitely the market should bounce, and it could extend because we could get a bit of a squeeze.
See there's a level there in the chart, like just before we hit 60 cents.
Yeah.
That's a really key level. If it gets there, like you see given all that was priced in.
60 cents.
Yeah, I know it's far away.
Oh, right, okay, yeah.
Like a week or so.
All right.
Does that point yourself like think of buying it?
Yeah, I mean the thing is, Stevens has generally talked about 75 cents being kind of where he sees fair value.
You said like 18, 85.
Yeah, he used to, but it's kind of he used to say that, but it's more, I guess he's recalibrated those lower as well as the commodities have come off, because he needs to talk about what makes sense for the commodity exporters in Aussie dollar terms, not US dollar terms. The commodities have come off. The iron ore, as we said, 50% in the last year. The Aussie dollar hasn't come off anywhere near 50% in the last year. So to recompensate essentially. So yeah, he used to talk about 85 cents being it, but in December he said 75 cents is probably fairer value. It might even be lower now because iron ore has come off another $8, $9 since December, but so has the Aussie, I guess. It's gone off 6%. So, but that for me would be the trade, the short squeeze trade. Yep, Ben.
What do you think about if they do cut rates, buying the dip on that, seeing as you've got like a 70% pricing, you may see what you saw with the euro, when you saw people liquidating out of their shorts.
Yeah.
You might just see.
Yeah, again, for that it would be depending on the statement as well,
Yeah.
what their tone was. Most definitely that's another alternative. But for me, I think there's more juice, and I will be looking for the buy on a short squeeze trade. But obviously you could buy the dip as well. But buying the dip, it's not necessarily risky. You need it to find a little bit of a base first, because we haven't been at these levels for 5.5 years. I mean, as Dan always says regarding the Bund, and Lee says regarding the Bund, selling all-time highs, it's a bit of a mug's game. But you know, these aren't going to be all-time lows, but we haven't seen this for quite some time. So you probably need it to find a bit of a base, then get on it, and then use your base as your stop level. Yeah.
Is there quite a strong correlation between the iron ore prices and the Aussie dollar then?
Yeah, there will be. There is there. I wouldn't say strong as such, but they need to, not necessarily in the short term, but over time the Aussie dollar essentially needs to adjust to compensate the iron ore producers. At a single split second, Probably not. It's more a medium to long term thing. Just like, you know, with you get oil and the US dollar, there's a very strong inverse correlation there. Okay, Aussie equities. So it's called the ASX 200. So since last week we've had, well, since a little bit before last week, we've had 8 straight up days in the Aussie equity markets, shown by these green candles here, and quite big up days too. So the Aussie equities seem to be liking this rate cut story, and they seem to be pricing in this rate cut. So, you know, if they don't deliver on it, it's pretty obvious what will happen. So that's probably a good place to trade if on a no rate cut. Yeah.
Question with that, would you be looking to go to the start of when, let's say they don't do anything,
Yeah.
you're short, where are you targeting that? Are you going to carry on?
So if I'm short and they don't do anything,
Yeah. Would you look to start from when the comment was released to that, so like the last 4 sessions?
yeah. So the comment was released. Yeah, it was about 4 sessions ago, Wednesday. Yeah, so 4 sessions ago. Are you saying what level would I look for it to come back to?
Yeah, would you look to come back to the starting price level?
Yeah, I mean before the comment, the article came out, the market was still pricing a little bit. It was more like 35-40% chance. So if they do nothing, it could actually go through there and all the way back to. This is a daily chart. Yeah, where it was at nearer the start of the year, which was around here. It could do that, but again, it will also depend on the statement. If they signal rate cuts are imminent, so don't just view this in isolation about cut and no cut. It's also the tone of their statement. And what I want you to do as well is go away and actually look at their last statement, and then you'll get a feel for what the tone was in the December statement, because it's not just about whether they cut rates or not. If they cut rates and say more to come, this will go like that. If they say cut rates, but this is just going to be kind of like a Canada's type situation, where with Canada they said it was like more an insurance cut to cover the commodity-based exporters on the low commodity prices. That Canada, I think Paula's it was, he said it was more an insurance-based cut. So it depends why they're cutting rates and the tone. So I wouldn't get into this bias of kind of cut means this, hike means this. It's a cut or no cut and the tone. You've got to look at them together. Okay, so we've talked about FX, we've talked about STIRS, talked about equities. Don't have a chart of it, but US bonds is another thing that you can trade on the back of this. I know the guys that sit with me, we looked at some of this over Bank of Canada, Bank of England minutes when they went from 7.2 to 9.0. The US bonds rallied not straight away, 2-3 seconds later. So if they cut rates, you might be able to just buy some US bonds, whether it be the 5-year, the 10-year, and have no heat on it. It might not go up if they cut rates. They might not do anything. But if it does, you won't be offside. I can guarantee you won't be offside. If you are offside, maybe a tick, 2 max. But if they cut rates, with Canada, you get 15 ticks in the space of 40 seconds. Okay, it reversed half the move fairly quickly. But it's just the US market, it will react to it because markets are correlated, especially in the very short term with things like this, you know. So just something to be aware of. You don't have to trade Aussie products to make money on this. Now, I will look to buy US bonds if they cut rates. If they do nothing, I wouldn't do anything because I don't think, I wouldn't sell them because I don't think they'll come on. I don't actually think US bond traders are actually thinking or care about the Aussie market too much. But if they hear rate cut, they'll be like, easing. And then they'll just buy. The initial knee jerk will be to buy bonds. So that would be my trade on there. I'd be looking to buy US bonds on a no move. Now, we could say that the Aussie market's obviously pricing in this rate cut. Why should the US market move? Because I don't think the US market cares either way what the Aussie market's pricing. They'll just react to a decision. And if there's unchanged, well, it will be status quo as far as US are concerned. They'll be, nothing's changed. Cool. All right, that's all I've got to say on this, guys. 3:30 a.m. for anyone who's going to come in, or even if you're not going to come in or not going to trade it, definitely something to keep an eye on. Central bank policy is very important. And it might just give us a feel and flavour for for some central bank meetings in the future, whether it's the Fed, whether it's the Bank of England, whether you trade this or not, it's good practice. You need to be looking at what's going on, how markets are correlated, where you can make money, what the FX markets do, what the equities markets do, what the bond markets do, what the STIRs do. You may not trade the Aussie markets, but you can get a feel for what they do. Most of you haven't seen rate cuts or rate hikes. So it's worth just bearing in mind what markets can do, and that's why this is important. And if you want to trade it, by all means have a go, but definitely use it as a learning experience regardless. Any questions? All right guys, cheers, thank you, good luck.
Thank you.